Okay, let's answer some questions here from Sunday's Market Outlook. I've been reading a lot about the different versions of all-weather portfolios, where you buy a compendium of different asset classes as uncorrelated to each other as possible, aiming for a set percentage allocation to each asset class, then simply let the quarterly rebalancing harvest some profits for you as you buy low, sell high. Well, that just sounds like a strategic asset allocation and passive buy and hold. Some investors choose to adjust slightly the set percentages for each class depending on whether we're at the beginning, mid, or end of a business rate cycle. There's tactical asset allocation. Some investors even write options to get an extra kick out of periodic rebalancing. So you've just basically described most of investing for most retail investors who have an external money manager. There'll be a strategic asset allocation that is decided upon based on your risk tolerance, and you go about your life. You come back every year for a review. Any major life changes, there'll be changes in your portfolio. If not, we'll see you next year. That's fairly common. I don't know that all-weather portfolio, that's more of a marketing thing than a statement of fact. That's just whoever's trying to sell you on this service is, using language to make you feel that, you're in a vehicle that's not going to slip and slide all over the road, right? So, for retail investors who most likely don't have alpha, therefore, their aim is to extract some beta out of markets. What is your opinion on these semi-formulaic all-weather portfolios? Well, again, all-weather, that's just marketing. That's whoever's selling this to you is just using that as marketing. This is not uncommon. This is basically if you go to your bank and you sit in front of a wealth manager and you say, I'm this old, I have this much money to save, here are my goals. He'll say, this is how we should invest it, and we'll see you every 5 years to renew. That's a fairly common thing. But again, all-weather portfolio, that's marketing. I've been catching up with your market updates lately after a break. I hear your thoughts on startups and their valuations in the States. There's been a certain tone, even in the Middle East, that deal flow isn't as great as it used to be compared to pre-pandemic. Well, that's true. Series B, C, D rounds slowing down, and startups shutting down at 212 thus far in Q3. Where does this leave valuation multiples? I'm not in that space. I'm not a VC or an angel investor really. So I don't know. I don't know the answer to that question. How do partners at VC and PE firms rationalize exit at a time like this? Typically, they don't. They'll try to extend the tail of their funds. So if they're in year 10 or year 11, maybe they'll try to get another year extension. But it's difficult to bring a company to market at this point. Can't really find data on the last one. General understanding of private market strategies would help as well. Yeah, that's not my thing, so I'll pass on that one. Why do you use operating earnings for PE measurement rather than net income? Well, because operating earnings are the cleanest number to use. There's a whole bunch of things that happen after operating earnings that are unpredictable, that simply are not part of operations, but are they could be a part of operations, but are not a predictable part of operations. And sometimes they're just not a part of operations at all, but just a cost of being a business in a country, in a regulatory environment that maybe did something wrong. So you want to assess your company based on what it can do from operations. How would you assess the probability of a dividend cut by agency or annually? Probability of a dividend cut, well, I don't know that there is some formula I could write on the screen and says, oh, here it is right here. It's just, having a look at, I think if I were agency, given the wide spreads between MBS and the 10-year Treasury, and given the the opportunity to add that spread to the balance sheet, I would be looking for cash to get it done. Either issuing more shares at this point in time, or cutting the dividend and using the dividend for reinvestment. Cutting the dividend is dangerous. It's easy. It's just easier to sell more shares to get this done, and they have done that through the third quarter. They did sell, I think, 44 million shares at an average of 9 something a share. That doesn't change. If they're trading above book value, then selling shares just benefits everybody else, right? If they're selling shares below book value, then it doesn't. It sort of hurts everyone else. You can't assess the yield based on the price that it's trading at. The price is going to reflect the tangible book value per share. And that will reflect the valuation of the assets, not so much the cash flow generating capacity and the safety and security of the assets, but just the market value of the assets. So I think a dividend cut is extreme. It would be an extreme thing to do. So I'd say that it would be sort of a last thing to do. If they are cutting, then it's probably time to cut in general. When working a full-time job, I tried to trade in 2022, ended up with negative 20%. Then again, in 23, negative 4%. Do you think for most people the safest thing to do is just 60-40 and hold, maybe adding a bit every quarter? Yeah, if you don't have the time to manage it yourself, you're not going to do it well, and you're not going to do it right, and you're probably not going to do it with any discipline. If you are working full time, your greatest return will be leaning into your job and being the best at it and moving up the corporate ladder. That will be the best return of your time. So at that point I would say stop doing it. On the other hand, look, 2022 and 2023 have been rough years, depending on, 2022, I think everybody suffered. 2023, if you just bought and hold and went away, you did okay. If you thought too much about it, you probably didn't do okay. But you can't judge 2022 and 2023. What you need to do is say, okay, well, 2022 I was down 20%. What was the market? Was the market down 25%? And if it was, then you did better than the market. But if you don't have the time, I would recommend just a 60-40 passive and have a contribution plan over time and just go away. Market was strange today. The dollar was unusually strong and climbed high, and yet the market didn't sell off like it usually does when the dollar climbs. I got wrecked today given I trade the negative correlation off. And could you share any insights in the move today or the correlation in general? The world is random. It has a drift component, but it's random. If there is a correlation, it means over many observations. In other words, a correlation is a statistic. It's not a deterministic relationship. It is a statistic subject to change. So if a stock goes up today and another one goes down, would we say, aha, I found a negative correlation on one observation? Well, you can't. It's over, you got to take 100 observations and see what their correlation is, because the correlation is a statistical relationship, not deterministic. So that it didn't happen that one day, that's well within the boundaries of a statistical relationship. When you talk about a correlation as well, keep in mind the correlation is a statistic. And a statistic has a confidence interval. You have to take the standard error of your statistic and calculate a confidence interval. Your confidence interval may have 0 in it. And if it does have 0 in it, then at a 95% confidence level, you can be pretty sure it's no different than 0. But it's not just, you can't just take a correlation and say, aha, it's negative 0.23. You have to look at the confidence interval around that, because it is a statistical relationship. Not interested in starting a hedge fund. Can you please elaborate as to why? Because it's a huge mountain of work in a crowded industry where the big money is mostly gone unless you're a big name. So it's just a lot of work. You have to invest a lot up front to get the structure done. You need to build a team. You need a marketing team. You need to get assets under management. Those 2 and 20 fees, you gotta be a recognized name to get the 2 and 20. You're not going to get that anymore. That's done. You're going to be pushed down to 80 basis points, maybe 60 basis points on your management fee, 8% hurdle, and maybe a 10% share of anything above that. If you have no track record, good luck getting assets under management, which means you're going to have to bring people in with track record. And it is not something you start. It is something that after you've developed a name for yourself and you have a client list and people know you transition into. But startups, no, I unless you have something, unless you've created some sort of algorithm that is just killing it and crushing it, and you can become a billionaire if only you had more capital. And that's why you start the hedge fund, to get capital to get you there. But just to do it, no. Now add on top of that quarterly stress. You can't invest for a 3 to 5 year period and say, this is my strategy. It's every quarter. Otherwise, you're going to have redemptions, and that's expensive. Not interested in that level of work and that level of stress. Just not interested. Not interested at all. Does working in the PE hedge fund side of the general account of an insurance company provide the same exit opportunities the investment banking folks get when they are looking to exit? Huh? Does working in the PE hedge fund side of the general account, okay, of an insurance company? Well, I don't know what you mean by working in the PE hedge fund side of that account. I don't know what you mean. You mean picking the PE funds and the hedge funds? Because the insurance company doesn't run a PE fund or a hedge fund. It just becomes a limited partner to a PE fund or a hedge fund. So I don't know what you mean by does working in that side provide the same exit opportunities as the investment banking folks get when they are looking to exit. Okay, I don't understand the question, so I'm going to pass on that. I don't know what it is you're asking. Studying level 1, really like the videos, but there is a summary explaining what Mark is looking at and how he interprets. Is there a summary? I don't think I have enough fundamental understanding of what he's talking about to fully grasp. But yeah, there is. Okay, for the market outlook, yes, there is. It's on this channel, Understanding the Market Outlook, I think it's called. Witnessing statements from automakers that the EV demand is below expected. I assume this is due to current macro environment, high interest rates, but also the fact that the average EV is not cheap and the market isn't ready for the full shift. Yeah, you pretty much got the whole portfolio of reasons there. Seems the governments are willing to postpone the massive transition to EVs, and that deadlines could move further to the future. And I think they will have to. This could also revert in the near future once the new growth cycle begins. Well, what you're saying is that anything could happen. I agree. Anything could happen. Did you change your bullish stance towards FCX and copper in general? I didn't change it, just tempered it a bit. I think the rise of India as an investment destination place will require a lot of infrastructure build out. So I think if India over the next 20 years can replicate what China did over the last 20, I think, copper looks good for the future. But yeah, the possibility that EVs won't make the transition from early adopters to mass market does work against a copper thesis. Do you believe in the 60-40 going forward? Yeah. There's a time to have greater strategic allocation of fixed income and maybe some inflation investments such as commodities or tips. It's hard not to be in fixed income right now. If you are, let's say, 45 and older, it seems rather difficult to make the case against locking in your retirement. You can pick up a 20-year, if you're 45, you can pick up a 20-year at 5.3, 5.4, and walk away. We live in a technology-driven world, and technology's only going to become a bigger and bigger part of the economy. The information technology sector is 28% of the economy. 28%. It's going to get bigger. And if you look at the relationship between industries that are more IT intensive versus those that are not, those that are more IT intensive are deflationary, not inflationary. So IT is deflationary. You're locking in a 5.4 on a 20-year with the very real possibility that over the next 20 years, inflation will average probably below 1%, not above 3%, but below 1%. I don't believe that we're entering an inflationary world, not with the pace of technology. It is productivity enhancing, and it is deflationary. It has always been deflationary, which means your real return will only increase as inflation drops. Your real return, it's hard to make the case that you shouldn't do that. It's just difficult. So I can't see an argument against fixed income at this point. And if you don't like government securities, that's fine. There's lots of investment grade debt from companies with very strong balance sheets, very strong cash flows that aren't going away for quite some time. You can look at companies like CAT, Johnson & Johnson. What are some of the other ones that probably aren't going anywhere? I think, I'm hitting a blank because I'm trying to think fast, but there are lots of AA companies out there where you can get investment grade debt up to 15, sometimes up to 30 years out. So it would be hard to make a case against fixed income right now. When buying corporate bonds and interactive brokers, does IB offer them at the clean price or dirty price? Well, I don't know. For corporate bonds, I don't know. I haven't bought one from them yet, but I don't know. I think it would just be a Google search and you could find the answer to that. Do I have access to the entire universe of corporate bonds on IB? No. Probably not. Like equities, is there a drip with U.S. corporate bonds? No, I don't know. I don't think so. No. Can I have the interest I receive on single name bonds automatically reinvested in the bond itself? No. I'm unaware of that. What's the path for TLT price assuming no changes in rates? And having in mind that TLT is an ETF and have to maintain stated duration and consequently sell some bonds at a loss. Well, you can, when you say no changes in rates, the Fed rate is not a market rate. It is just a target that the Fed tries to achieve on an overnight basis. all the rates you see, the 1 month, the 3 month, the 6 month, the 1 year, those are all market determined rates now. The money market rates will reflect that target rate. But when you go all the way out to the 20 to 30 year end of the curve, they're not reflecting monetary policy directly. Like the 2-year imports a lot of monetary policy into it, but the 10-year, 20, 30, more about growth and inflation expectations. And of course, it's affected by term premiums due to supply and demand, things like that. But it is not necessary for the Fed to change rates for the long end of the curve to have a bull flattening. The Fed doesn't have to do anything. But let's just assume that rates do not change anywhere on the curve, that you expect a stable yield curve out for the next 2 years. TLT's net asset value would most likely drop as it sells bonds. Well, you know what? I don't think so. Hang on. Let's change that. You might have realized losses as you sell a bond, some bonds, to reinvest at the longer end of the curve. You might have some realized losses, but you're buying a bond with the same yield. So maybe you're selling a bond that's yielding 5.3%, and then moving into a bond with different duration that has a higher yield because you're managing the coupon that you're buying along with the term to maturity, or has the same yield. So you've taken, let's say, $10,000 out of this bond at 5.2% and put $10,000 into that bond, a longer term bond with a higher duration at 5.2%. Your $10,000 is still yielding 5.2%. All you've done is created a realized loss. I offhand, I really don't know the answer to that question without really looking at the statements for TLT to see how they manage their duration. They could, and I don't know if they do, they could simply manage their duration with derivatives. If it involves, they might have some something in the bylaws of the ETF that says we don't sell to manage our duration. If we have to sell at a loss, we'll use futures or some other derivative to maintain our duration as opposed to taking a loss. So off the top of my head, I simply can't answer that. All right. Given the July debt ceiling removal and around $2 trillion added for government debt, my take was this played a role on consumption, but the G component was the third biggest value. Let's just put something in perspective here. This $2 trillion. If you say that you add $2 trillion to debt, keep in mind the reverse repo was like $2.2 trillion. It's now down to $1.1 trillion. So that was a form of debt that the central bank had to meet. Being that the central bank returns all its profits to the treasury anyways, it was an expense of the treasury. Now it's not there. It's 1.1 trillion, and it's now in money market funds. So it's all you've done is said, well, we were paying some interest over here. Now we're paying interest over there. So I don't know that I'd say it's an incremental 2 trillion. Only because the reverse repo, about 1.1 trillion, moved from the reverse repo to the T-bill market, and the reverse repo and T-bill market were both forms of cash outflow, ultimately from the Treasury, because the Fed returns its money to the Treasury, and if it's paying out on the reverse repo, that's money that wouldn't have been returned to the Treasury, thereby making it the Treasury's cash outflow anyways. Also confusing because this is federal level debt, but within G it was dominated by state and local. I don't know how I guess I'm just not understanding a lot of the questions today because I don't know what the question here is. I'm confused how increasing government debt flows through which channel. Well, you'd have to look at the budget, right? So let's say that I charge $15,000 on my credit card, but you don't see me spend an extra penny on anything. The question is, well, what was the $15,000 for? And maybe it was for somebody else that somebody else spent the 15 and I just allowed them to use space on my credit card. So you'd have to look at the whole budget to determine where the money is going, as opposed to saying, well, shouldn't it be G? Well, what was it spent on? So it's you have to go to the budget and figure that out line by line sometimes. Do you have any thoughts on small cap to large cap forward PE discrepancy? Well, small caps would be under a lot more pressure than large caps from a balance sheet perspective. They're probably less creditworthy, probably less able to access debt markets, especially with smaller size, may not have the asset value on their balance sheet to issue secured bonds, which most high yield bonds are secured bonds. Probably more likely to have variable rate debt than fixed rate debt. So they would hurt more in an interest rate rising environment, and it would be perfectly natural to see them trade at a valuation multiple lower than the large cap peers. This is the largest discrepancy over the last 2 decades, most likely because it is the highest level of money market rates and highest level of debt rates we've seen over the last 2 decades. Last time they traded this far apart was 1999, in which over the next 3 years, small caps outperformed by a fairly large margin. Do you see any opportunity here? There's always opportunity. I mean, whenever you're trading at the extreme points, there's usually some opportunity there. But you have to think about the higher for longer environment, and is that going to play out? And if it is, then small caps can continue to underperform for years. So to just jump all the way in, I'd say, not really, but to have an allocation of small caps, sure. But I don't know about going all in. How do you find the cost of capital discount rate for a company that only holds bonds? That's an oxymoron. You can't have that. A company that only holds bonds is not a company, because if it only holds bonds and it has no equity, it's not a company. It's a government agency, or it's a nonprofit. There has to be share capital, right? There has to be some equity. Somebody somewhere must own something. Once all the bondholders are paid back, it must belong to somebody somewhere. So to say a company that only holds bonds, you're missing something there. You're missing something. So, to what extent do you think mortgage REIT ETF would be impacted by a fall in housing prices? Well, if they're agency mortgages, zero. Agency mortgages have a de facto government guarantee. They're not a mortgage. Your mortgage payment does not change with the value of your house. So if the price of your house goes up or the value goes up, you still pay the same amount on your mortgage. If it goes down, you still pay the same amount and you still owe the same balance. So the balances do not change just because housing values change. And if you have the government guarantee, if they're agency-backed MBS, then no, it wouldn't matter. My Thinkorswim platform right now shows the SPY 1-year options at the money calls have an IV of 26%. At the money puts have an IV of 14%. Any idea why the puts and calls with the same strike and same expiration data would show such different IVs on a super liquid vehicle? Nope. No, I don't. Bit more about agency and Annaly and why they were almost declining. Why they were almost declining? I checked the spread between 10-year and 30-year. It was influential, but didn't justify all this decline. Yeah, I can't answer that. That would require me to do a deep dive on those two to figure out what was going on. The number of, what was the share count? How were the shares issued? Where did the changes? I think if you want to do something here, take the last 10 years, go the last 10 years of annual reports, go to the statement of changes in equity, and figure it out. They will reflect their tangible book value per share. So if you're looking for the answer, it's going to be in the changes in equity, the statement of changes in equity. But I mean, I can't, it's probably not just one thing. There's probably a confluence of factors. You have to just tear it apart and figure out what it is, but that's a deep dive I'm not going to do. For retirees, when the balance sheet runs off, where do they invest that money? They don't, they spend it. They buy food, they go to restaurants, they buy clothes, they do house repairs, they buy gifts for their grandkids, they spend it. A little bit of guidance on money market fund assets at level 3 covered pensions, foundations, and endowments. I just want to know how money market funds work. Well, money market funds they're nothing like that. Money market funds just hold money market securities. The securities that have a maturity less than 1 year sold on a discount basis. That's all they do, is they just hold that. They're basically, it's just an alternative for cash. They're called cash equivalents. Car companies are exiting the EV market. Well, I don't know that they're exiting the EV market. Could this potentially result in Tesla returning to its earlier robust margins? No. They're not exiting the EV market. They're just, some are slowing down their ramp up. But exiting, no. I don't think any company is considering exiting the market, shutting it down and saying, no, not for us, thank you. I think all car companies see that at some point this is going to be the thing. It's just EV is not ready for mass adoption yet. It needs significantly longer battery life. It needs significantly lower repair costs. Avis Car Rental, I think 2 years ago, remember it announced that it was going to buy 100,000 Tesla EVs. Well, it's pulling back on that, saying, whoa. Two problems with this. Number one, these cost twice as much to repair as any other vehicle. Number two, they depreciate much faster. So they're coming into the realities of being an early adopter to a technology that isn't ready for mass market yet. You'd have to get that battery range from 300, 400 miles up to 800-900 miles. You'd have to get that charging down to 5 to 7 minutes for a full charge. But to sit for half an hour for an 80% charge on a 280 mile range battery, for most people, that's just not an option at all. If you've got to get somewhere and suddenly you need to pull over somewhere and charge for half an hour and sit there for half an hour, that's simply just not, for most people, that's just not an option. The extra cost, the extra repairs, most people don't understand. You wear out your tires at a much faster rate on an EV because of the weight. That battery's heavy. So you have to do something with battery chemistry. You have to, I don't know that pure EV is the solution, other than just for in-town driving, somebody who only drives to work and back and really doesn't do much else. I think a dual type of engine where you have battery and something else is probably the solution. Tesla returning to its earlier robust margins? I don't think so. I don't think so. Those margins are gone. They're not coming back. In fact, they're probably still a bit too high. So no. Why do some companies only release 8K on its earnings date, then release 10Q a couple days later? That's fairly common. you'll have earnings, you'll have the conference, the call, the analyst call, and a couple days later the 10Q is available on the SEC site. That's fairly common. I don't know that I've ever found a day where the 10Q was available on earnings release date. I don't think that I've ever found that. I think there's a date at which they declare that our statements will be up by this date, and we'll present to the public a couple of days earlier. So I don't know laws surrounding such action. Google SEC and that statement. You'll probably get something. Mentioned you bought 25-year U.S. strips. Quoted price is 27-28% of face value. You said if interest rates decline to 30% next few years, your potential gain would be that's not 2.6. 2.6. So if you have $1, you get 260, not 260%, right? How is this possible? Oh, I've been asked this before, and I'm not going to go through the calculations on this one. Just calculate it. That's I guess that's all I can say. I don't have to sell. Trying to understand TLT more. Different sites showing TLT with a yield of 355 to 387. Is a way to accurately correct the yield? No, there isn't. TLT trades every minute of the day, every second of the day, every penny it changes the yield. You can calculate the yield a number of ways. You can look at the dividend it paid in the last 12 months versus the price right this second, which isn't a very good way to do it because the dividend changes every single month. So you can do an SEC 30-day yield, which is saying, well, what did it pay out in the last 30 days? Multiply that by 12. But that is no guarantee that the dividend going forward will be the same amount every single month. So you can sort of just come up with, okay, well, it paid 28 cents last month. That's $3.36. It's $85 a share. Calculate a rough yield and say, well, it's about this right now. But the yield will change every time the price changes. Difference between agency and annually, besides one being bigger than the other. Well, I mean, you'd have to go through each statement and determine, well, how much interest rate risk are both hedging? What is the fixed rate on their interest rate swaps? What is the leverage factor that they happen to be using? I mean, there's a lot. There's a lot that you'd have to go through. I believe you said you're now bullish on these names at current levels. What's the bull case and what is the bear case for these currently? Well, the spread between MBS and 10-year is super wide. I mean, really wide. Wider than it should be, being that these are agency-backed securities. It's wider than it should be. So, you want to step in at these extreme points. Bear case is the spread gets wider. Does the Fed need to cut rates for the bull case to play out? Nope. You mentioned your successful micro bets more than offset your unsuccessful macro bets. Would you say that most years your macro bets outperform? Yeah, macro does very well. Macro has done very well for quite a long time. It's just this is an odd year for macro. I've seen and heard comments about there will be dividend chasing after the Fed cuts rates. I can't comment on that. I don't know in what context you saw the term dividend chasing. And I usually don't comment on things that start with, I saw, I read, I heard somewhere. Comment, please. Well, did you see it that way? Where did you see it? Who said it? Was it a trusted site? Was it one of these marketing sites that are trying to sell you something? Dividend chasing is going to be good, and we got the list of stocks that you need. Did you understand it correct? Like, there's a lot that I have to accept when somebody says, I heard, I saw, I read somewhere. So I don't know how to answer that one other than to say, since I don't know the context in which it was said, since I don't know who said it or why they're saying it, it could be anywhere from very insightful to outright bullshit, right? So I mean, I don't know. If the 210 disinverts, do you believe this will be a catalyst for equity market downturn if one has not happened already? No, not really. That's a capital market slope. It's the money market, the capital market that matters more. But higher, longer rates, well, they're not positive for the economy. They're not positive for investment, and they're not positive for the present value of projects. So it's negative on that side. Any interest in Brazil or emerging country over the next cycle? I don't know anything about any other countries, so I tend not to get involved in things I know nothing about. Treasury needs to sell 775 billion. BOJ needs to sell too. Do they? I mean, you're making a statement that I'm not ready to accept. BOJ needs to sell too. Are you sure? I mean, this is something that has been that we can verify. Is this true? I mean, we can convince ourselves of all sorts of things by simply saying sentences and then just sort of accepting it as true. Is that true? BOJ needs to sell too. I don't know. Is that a true statement? Or is that your opinion? China Treasury's liquidation is also on the way. Is that true? Or again, is that just an opinion? Are you trying to make a case for something and just saying statements that, if they were true, would make your case? Because you're going to put money at risk. Wouldn't you want to make sure that those are true statements? I don't know that the BOJ needs to sell. I don't know that China Treasury liquidation is on the way. I mean, they could just be opinions, but I don't know that those are true statements. With so many bonds on the market, is it reasonable to expect 10-year yield to go much higher than 4.8? So can we expect equities will come a lot under pressure as well? Well, I'm rejecting two of your sentences. I don't know that this is true, and I don't know that this is true. So if your question rests on these three statements being statements of fact, well, they're not. Only one is. The other two, I don't know if they're true. BOJ could be a buyer. China could be a buyer, and this whole thing goes away. So I don't know that those are true statements. Did you just say that you expect significantly higher yields on the 20 and the 25? No, I didn't say I expect significantly higher yields. They do have higher yields. If you look at the 10 to the 30, the 20 has higher yields than the 10 and higher yields than the 30. The 20 to 25 segment is an odd segment of the curve. You can get a higher yield in that area than you can with the 30. What's your opinion on private equity funds and investment in such funds? You got to have the money, right? These are big lockups. You have to not need that money for 10, 15 years. Because there's no redemption in private equity. It's not as if a year in you could say, I'm issuing a redemption, I'd like my money back. It's like you'll get it back when you get it back. You can sell your partnership interest to someone else, but it's going to be at a discount. So you have to not need the money, absolutely not need it for 10 to 12 years. I think you had a talk in the past about a portion of your portfolio being invested in investment vehicles a retailer couldn't touch. That is true, and I'm leaving Canada, so I have to liquidate my holdings, but these I cannot. I'm locked in, which means even after I leave, I'm going to have some Canadian assets, which complicates things, but that was the deal. You're not going anywhere. You have to wait. You have to wait for the redemption date to happen. You could try to sell it off, but you're going to be selling it at a discount. So you may as well wait. So it's a lot of my question has arisen after finding pitch book. on real asset deals, there was an analysis on oil that I found interesting and really to hear your thoughts on the matter. Wow. If you're gonna have to share, you're gonna have to share it with me first before I can give you a thought on it. Hey, I heard something about ABC. What do you think? Well, what did you hear? I don't know how to answer that. Out of the emerging markets, which one do you reckon have a bright future over the next 5 years? India, by far. Risk-free rate of 2.5, 1% real, 1.5 inflation, equity risk premium 5, equity. Oh, I'm not doing that. Okay. In regards to SOMA and how it categorizes balance sheet items, how do federal agency securities differ from agency MBS? So a federal agency would be something like the Tennessee Valley Authority or the Federal Home Loan Bank that issues debt. That's all. It's just a bond issued by a federal agency, and it needs money to do something. That's all. Agency MBS is, well, mortgage-backed securities. Agency meaning it's got an implied government guarantee on these mortgage-backed securities. It was a government agency that issued them, basically. These other ones is just a government agency that issued debt, not backed by anything, but hey, we're going to issue some debt. What S&P level are you comfortable at? I don't know that anyone's ever comfortable at a certain level. You're interested or you're uninterested. I don't know at this point. There's too much uncertainty. However, you have to combine it with your investment horizon. If you have a 6-month investment horizon, you're probably full of uncertainty right now. If you have a 10-year investment horizon, who cares? Go ahead and buy, and in 10 years it will be higher. Or sometime within the next 10 years, the market will be higher. Have a reinvestment plan, have a regular contribution plan, and in 10 years or sometime in the next 10 years, it will be higher. So you can be comfortable with the market at any time, at any point, depending, if you have a long-term investment horizon. Strike in GM has just ended. Yep, UAW reaches deal with GM for now, and we'll see them again in 3 years, right? And then another 3 years we'll see them again, and then another 3 years we'll see them again, and on and on and on it goes. Some say buying and selling in secondary market doesn't create any value to society. Who are these who are these people saying that? What do you think of this statement? Well, I think it's a silly statement, number one. To say that it doesn't create any value to society is really short-sighted. Imagine for a moment there was no secondary market. How many companies the size of Apple do you think would exist? How many companies could invest millions in a cancer research drug and make a major breakthrough if there was no secondary market for securities? How many people would be able to access economic growth in an efficient way to build wealth for their retirement? I mean, think about it. The financial functions of the economy, get accused a lot of not providing any value, but they provide huge value, because if they didn't exist, you wouldn't have the economy you have today. You wouldn't have the innovation. You wouldn't have the breakthroughs. You wouldn't have the level of employment that you have. Pick any market that has no stock market in its country, and I will show you an extremely poor country. So yes, I would say not only does it create value for society, it is the very mechanism by which allows for a society that you'd want to live in to begin with. So I don't know that you should be knocking Wall Street, or whoever these some people are should be knocking Wall Street or knocking finance, because without it, you wouldn't have a mortgage, you wouldn't have a house, you wouldn't have a car loan, you wouldn't have any of those things without it. So and that all comes from secondary markets. If there were no secondary markets, Why would I ever buy anything I can never sell? Why would I ever do it? You want to raise money for your company, and I think, yeah, but who could I ever sell it to? There's no secondary market. I have to go around and I got to find somebody that wants to buy it from me. No, no, no. That would be a terrible society to live in. How can agencies sustainably make money going forward if rates stay higher for longer? Well, because it's not a subject to interest rates. It hedges out interest rates and levers up the spread. Levering 150 basis point spread. Well, try 300. It's closer to 300. With short rates at 5.5 doesn't work. This is a spread. That's a spread. That's not an interest rate. That's a spread above an interest rate. When short rates at 5.5 doesn't work, yeah, it works for agency. They have long dated interest rate swaps in place. I think their fixed rate's well below what the 10-year yield is. I think their fixed rate is pushing up to 2.5%. Last I checked on the fixed. So they receive a floating rate, they pay a fixed. The floating rate they receive is the 5.5 on their overnight borrowings. They pay 5.5 on their repos. They pay 5.5, but they're getting 5.5 and paying out 2.5. So their financing costs are really low. I think you're confusing the interest rate component with the spread component. When swaps roll over, the cost of funds could exceed the asset yield. Well, no. Even if they roll over, the fixed rate, being that we have an inverted curve right now, still inverted, the fixed rate on any swap will still be lower than the cash rate. I doubt that I would, if I were part of agency, I doubt that I would advise entering into more than a 1-year swap. I don't know that I'd enter into a 5-year fixed for floating with an elevated fixed rate. But if you're hedging out the interest rate risk and levering up the spread, who cares what the interest rate? Who cares where interest rates are at that point, right? You're hedging it out. You're using derivatives to hedge it out anyways. Assuming they maintain zero duration. Oh, I see what you're saying. Yeah, okay. On the interest rate, yeah. That's what they try to do. Actually, I think they have negative duration because they're overhedged, like 116%. What is your view on gold? I've never ever been a fan of gold. Never cared for gold. Never understood why anybody wants it. I have no view on it really. How do you know the age cohorts that are decreasing their treasury? Oh, that's already been replied to. This was an odd one. Purchase some agency $7 call, sold the agency $3 puts, but you're not giving me a date. And there's no money in the puts, but it is past tense. Purchased. So maybe you did this a while back, but still the threes. What were you getting on threes? Even where they are now at $7, $7.50, the threes there's nothing there. Okay, do you believe in Santa Claus rally? Well, no. I mean, I don't believe that there is something that exists called that. I think it is something that people like to say. The Santa Claus rally, I think it's just something people like to say. Maybe it happens, maybe it doesn't. But I don't know. Who are these guys? I don't know what that refers to. Do you think micro E-minis are an efficient way to short the market? Effective way? Well, yeah. I mean, that's what it is, right? It's effective, but I don't think that's what you meant to ask me. I think you meant to stick a word in front of here. Effective way to short the market, either to say the cost effective or an effective way to short the market given a small account. But I mean, it's an effective way to short the market, sure, because it is the market. It is an S&P contract, albeit a small contract, that I think is equivalent to 50 shares of SPY, but it is effective. If you need to take a position that is equal to 10,000 shares of SPY, it's not efficient. It's effective, but it's not efficient because you'd need so many contracts and you're paying the same transaction fee per contract. You may as well use the bigger contracts, right? So, but for small accounts, it's both efficient and effective, yes.